Good morning and welcome to this Moneycontrol live stream. You're watching Opening Bell with me, Nandita Khemka. Seems like we are in for a dull Friday. Last night we saw, an AI-driven sell-off taking shape on Wall Street once again. Nvidia, slumped quite a bit despite a blowout quarter, and of course, Nasdaq tumbled over 1%, and even US futures are down. Asian markets were trading largely mixed. The GIFT Nifty was hinting at a triple-digit cut last time I checked. So things aren't looking all that great. The rally or the up move that we've seen over the last couple of days could fizzle out this Friday. But lots to watch out for, lots of stocks in focus. We'll be talking about that. We'll be taking all your stock-related queries as well. Keep them coming in. We'll get them addressed by our experts on the show. But before all that, quickly take a look at the top stories at this hour. Wall Street ends largely lower after Nvidia earnings beat failed to lift the market. The Nasdaq ends more than 1% lower, while the S&P 500 fell a little over 0.5%. Asian markets open largely lower, tracking losses on Wall Street. Meanwhile, the GIFT Nifty is suggesting a lower start for the Indian market. Oil prices ease after the latest round of US-Iran nuclear talks end with significant progress made as per mediators. Gold prices are steady, while silver inches downwards. Well, the government will unveil a new GDP series today with FY23 as the base year versus the current base year, which is 2011-2012. And a Network 18 poll sees 7.7% as growth this quarter. Well, very quickly, as I said, global cues are looking downbeat. If you look at our markets as well, we closed largely in the green. It was a volatile session. It was the Sensex monthly expiry as well. We ended near about the 25,500 mark. There was a move within a 170-point range on the Nifty. It has been fairly volatile. Even day before yesterday, we clocked in 25,600 or so, but we didn't really manage to sustain those levels. Today, of course, setup isn't looking all that great, but support largely seen around 25,350 to 25,400. Resistance becomes 25,600, and that's been the upper band that experts have been talking about. But aside of that, if you look at fund flows, you did see FII, selling coming through. FIs have turned buyers, by the way, in the month of February, and the buy figures are looking pretty solid. That's something that the market would take heart from. But, to understand today's setup, let me bring on board our guests. Joining me right now is Raja Venkataraman, co-founder of Neo Trader, and Mayuresh Joshi, Director Research at MarketSmith India. Gentlemen, lovely chatting with you as always. Seems like we are in for a rough Friday. Sentiment was turning around a bit and FIs have come back. So that's something that's good news, but AI has been a pain point in recent times. So I'll start with you, Raja. What are the levels to watch out for today on the index, and what would be a trade for today? Would it be Nifty or Nifty Bank?
Yeah, good morning to all, and thank you for inviting me to the show. So when I take a look at the overall market sentiment, I feel that the lower levels are being well defended, and the focus right now should be not on the indices, but on the sector specific action that is emanating. And it is very clearly evident that there is a continuous sector rotation that is going on. So earlier we had metals, then we have pharma yesterday firing up, then also the defense is also getting into play. So as long as I would say that 25,400 is defended and we don't get an end of day closing below that, we should continue to look for greener pastures here. Yes, the AI driven rally is primarily a tech driven scenario. So I would say that yes, it is impacting the market, but then I would say that the overall cues which are emanating, especially from the global side, is actually influencing us to think that the market is under pressure. But I would say that sectorally, the markets are performing quite well. And if you dip down into the sector specific action, and in that there are certain stocks that have been able to retain the bullish sentiment. So I would say that should be the play going forward. Yes, markets are going to take some time to develop. So as long as 25,800, we don't get a closing about 25,800 on the Nifty spot, I would not be a buyer on any of the indices. And on the Bank Nifty, I would wait for a closing about 61,500 to be comfortable. Till then, I would say that go for the even if you want to go, PSU bankings are performing well. Go for all the PSU banks that are showing a much better performance than the private ones. So I would say this is has to be the play going forward.
Okay, that's the view. Of course, certain sectors are doing well. Perhaps those are some pockets that one can look at. But Mayuresh, what are your overall thoughts on the market now, given the fact that FIIs have really made a good comeback this month at least. If you strip away the AI impact, aside of FII comeback, what else would you really look out for on the positive side for the market? Today we have the new series GDP data coming through. Anything in particular that you'll be watching out for from there?
Morning, Nandita. I think the new series will probably have a surprise in terms of the reported print. However, I think consistency in that print is something that the markets will look out for. I think the one big positive that is coming out is that Q3 numbers have been steady state. And I had attended a lot of conferences over the last few days and weeks, in the last couple of weeks, and met a lot of corporates across different domains. And the general thread coming out of all these conversations were that earnings are probably looking steady, and there is a large optimism that earnings should improve quite significantly as we head into the second half, based both on improving macros for our country as a whole and improving dynamics for individual sectors and companies within that as well. So I think the one big takeaway is that a large part of corporate India is looking for a better earnings growth as we head into the next financial year. And that might be the biggest takeaway because markets will ultimately get swayed by how earnings will play out. They've largely disappointed over the last few quarters, but with steady state earnings in Q3 and expectations of improvement happening from the first half of the financial year, I think that becomes a very, very optimistic bull case for the Indian equity markets.
Sure, earnings, that will be a key factor to watch out for. And the nominal GDP, by the way, last time wasn't really all that great. Perhaps that's one thing that the market will also be watching out for in today's numbers. But, tactically, Mayuresh, how are you looking at the market? Because, for the Nifty itself, it hasn't really seen any kind of a follow-through buying, so to say. The moves are fairly sideways. It's 150, 200 point range that the Nifty has been moving in. Do you see this range being broken either on the downside or upside next week? If yes, what would be the trigger for that?
I think two important aspects, as you pointed out. One, I think the AI-led disruptions is something which is creating a lot of havoc, not just across selective product and platform companies, but across a lot of domains where AI can probably create a huge amount of disruption in the ways of how things are operating as we speak. The second element, obviously, is from a macro perspective. Global macros are still not coming up the way one probably expects. And therefore, inflation and growth dynamics globally reflected by global bond yields is something to monitor. The third important aspects will be obviously the geopolitical news. What probably comes out in terms of the US-Iran talks in the coming week, and whether we get some element of an headway in terms of the discussions that probably happen. I think once we get a good amount of clarity on a combination of these factors put together, my own sense is that the markets will then take this forward in terms of each individual market. In our case, obviously, I think macros are looking very, very good, stable, and micros are expected to show significant amount of improvement, which then means that if these conditions are tackled, I think the macro and micro conditions for India probably look steady state. So no structural declines in my opinion. I think the optimistic view is there is potential upside as far as the Indian markets are concerned. Maybe a phase of consolidation till we get clarity on all these three aspects.
Okay, those macro factors, to keep on your radar. Perhaps that would, at least get the Nifty out of the range that it has really been trading in. But let's break it down to stocks then. Raja, since you mentioned metals as well in your earlier answer, and metals, as a pocket, has have been emerging as one of the pillars for the market time and again since last year when there was weakness in the market. This morning, I want to just address Hindalco, given the fact that its Aluchem acquisition has been temporarily halted due to the US government shutdown. This comes as a setback, but overall, Hindalco has been doing fairly well along with the other metal stocks. I beg your pardon. What are your thoughts on this stock? Do you see some bit of pressure coming through? If the stock opens with a negative bias, would you be a buyer today? How would you approach?
Yeah, so overall, if you see that, yes, the news may dent the optimism in Hindalco, which has been trying to revive from lower levels. But then overall, if you see that the metal pack itself has been performing quite well. So this dip would actually be a good opportunity to get into. Overall, the metal space is quite encouraging, and when you want to take advantage of the metal space, it's better to go into stocks that are already performing. So if you were wanting to get into the metal pack, then I would say the stocks that are performing quite well and then also link with the metal performance is one is VDL, and also from the other side is JSW Steel and Jindal Steel. So these are some names which I'll be looking for if I want to trade the metal space.
Okay, keep those names on your radar. But coming to the next stock that's in focus today, that's Vishal Mega Mart. Now, sources suggest that Samyat Services is likely to sell stake via block deal. Now, they have upped the offer size. Earlier, the size was, I think, 3,500 crores, but it has been up to 7,500 crore rupees. And of course, the floor price has been set 115 rupees per share. That's a discount of almost 10% to the current market price. The stock has been doing fairly well in recent times. Mayuresh, any thoughts on Vishal Mega Mart, or would you look at the likes of Trent, which has really underperformed, and there's no sign of a pickup? But valuations wise, which one would you tilt towards?
I think Trent still remains expensive, Nandita. And again, I think the large part of the expectation is that the kind of guidance that Trent has probably given in terms of both revenue growth, margins, and bottom line growth, that might start coming back because I think quarter three, after GST rationalization or the GST cuts, was a quarter where I think there was a lot of inventory rationalization that was expected to happen. But with a lot of elections expected to happen this calendar year, the expectations in terms of a lot of MSPs being introduced or otherwise might actually make us believe that both these aspects put together might act as an enabler in terms of discretionary spends. And therefore, I think a little bit tilted in terms of how Vishal Mega Mart's operations are probably spread out. A large part of that is in rural and semi-urban areas. The ticket size is pretty affordable with MSP prices expected to increase and discretionary income expected to increase in rural and semi-urban households. Large part of that pool might come down in terms of discretionary spending. And Vishal Mega Mart probably has a good mix in terms of apparel, FMCG, and others as well, including groceries. And their presence and the expected presence in terms of more expansions happening makes it a better candidate in terms of expectations of same sales stores growth over the next few quarters.
Okay, that's the view. Vishal Mega Mart, of course, looking good. But on the charts, how would you look at Vishal Mega Mart, Raja?
Yeah, on the charts, yes, Vishal Mega Mart is trying to make its way up. But then that's what I was mentioning earlier, that in every sector, there are certain performers that have been working out. And yes, you can say that, yes, the overall FMCG space is trying to show some up move. But then I would say that once this news flow goes by and the market shows its true reaction, only then we should be actually looking at this stock, but not entering it today.
Okay, not entering it today. That's Vishal Mega Mart. Mayuresh, I want to get your thoughts on your latest thoughts on some of these IT names. Saw some buying traction over the last couple of days. Of course, today, we have negative cues when it comes to global tech names, but I think overnight ADRs have done pretty well. Which camp are you in? Would you say that this is the right time to get into some of these IT names? given the valuation comfort post the kind of correction they've seen. Month to date, they're down in excess of 15-18%, although they've paid some of those losses, but still, hefty losses there. But, would you look at it from a valuation standpoint? Because a lot of the experts are saying that it is, valuations may be okay, but it's still a wait and watch scenario that they will go by. So, what is your sense?
I think it's still a wait and watch. I'll give you the reasons why. One, I think in terms of how numbers have played out, I think it was in terms of market expectations. Second, in terms of the AI disruptions, what is really happening is that a lot of larger enterprises or mid-sized enterprises might actually look at deployment of AI across their application stacks, which might reduce their operating costs to a large extent. Obviously, I think it's not going to be a full-blown exercise because they'll still like to watch under a test environment on how the whole module is probably working. And therefore, under the existing model that our IT companies are probably doing, you'd still get steady state orders, at least over the next 4 to 6 quarters, with the same margins that we are probably looking at. What the street is probably a little bit fearful is beyond those 6 8 quarters, if AI disruptions actually turn out to be faster and more disruptive than one probably thinks or believes, what then happens to the future order book, the future cash flows, the future margins, etc. So it is more a question of forecasting on what AI might or might not do in terms of the existing models. However, the fact remains, Nandita, that AI is here to stay. And therefore, an adaptation both for our existing IT models have to probably change and modify itself. And that will entail some element of a capital expenditure in terms of either acquisitions or developing those models and upskilling of employees, which might take some element of hit on margins. And therefore, that re-rating component in terms of forward multiples become a little circumspect. So it's a wait and watch. Let's see probably what happens. But I think the price damage is largely done for the sector. It might go through a phase of consolidation.
Okay. Okay, got your point. The price damage may be nearing its end, so to say, when it comes to some of these IT names. But on the charts, how would you look at some of these mid-cap names in particular? Because we have queries coming in on Coforge. Cameron wants to know whether it makes sense to look at some of these mid-cap names like Coforge. Your thoughts, Raja? Would you advise?
Yeah, IT is currently going through a lot of pain at the moment, and yes, I would say that even if the selling stops, the rallies would be used to sell into. So, as a sector play, I would say that it's best avoided, and we do not engage in bottom fishing, because the way the markets are behaving right now, well, AI is definitely here to stay, but then people have not yet adopted it, and the way people are going about and the knee-jerk reactions that we are continuously witnessing in the market is clearly evident that people are not very clear about what is going to happen and what is happening. So in such a scenario, getting into IT, well, IT was one of the preferred sector a few years ago. Now, I think that the preference should change, but that's what is taking time for the people to adopt. So everyone is trying to look into a mid-cap IT. That was actually performing better than the larger names. But then now what has happened is that AI across the board has punctured every kind of sentiment here. So I would say the sentiment is going to take some time to recover. So probably I would not get into IT at any point in time. Even at lower levels, I would say that it's going to take some time. And if it gets into a consolidation, your investment is stuck. So there's no point in getting into IT.
Okay. That's the advice. Hope that answers your query, Kevin. But another pocket that has seen a reaction, a very, very dire reaction to news flow is the entire solar sector, right? The likes of Vari Energies, Premier Energies, Vikram Solar, all of them took it on the chin when that announcement of a 126% tariff on Indian solar imports was announced. So on that sector, we're getting quite a few queries. Arya Kumar wants to know whether it's the right time to add more of Vari Energies after the correction. His buy price was 1856 and he's still making a profit of 40-45%. Mayuresh, your thoughts on what this development means for some of these solar-based companies, and any advice for Arya? He's still making a very, very solid profit. Congratulations to him. But what should he do? Should he add more, or should he look at selling some part on rallies or on any kind of up move?
I think always booking some element of profits if you are making a decent one is always mandatory, and that's what we do in markets with India. However, I think in terms of the new regulations that have probably kicked in, where the taxation of 126% as far as US is concerned will be at the manufacturing unit and not where it is probably imported from. And therefore, I think a lot of companies have made it very, very clear. Premier probably has no exposure. Vari has only got a 10 or 15% exposure as we speak. However, I think the question beyond that, Nandita, is that if you probably spread it over the next 3 to 4 years, are there questions of oversupplies and therefore pricing coming under pressure is the bigger question.
Okay. Oversupply and pricing pressure. Those are some of the things to monitor over a 3 to 4 year period for some of these solar based stocks. But hold that thought. We'll just take stock of the pre-open rates. Not looking good, of course, but it's a 50-point cut on the Nifty as we speak in the pre-open. 25,450 around about that level. Sensex showing a cut of somewhere around 20 points or so. It's not looking that bad at the current juncture, but we'll still wait for the rates to settle down a bit. Looking at some of the Nifty movers, I don't know why Nestle is showing 9% down in the pre-open. ICICI Bank showing 5% down. I think we'll wait for some of those rates to settle down. We have to see how we really settle in a few minutes before really thinking that the rates are so down. But yes, Nestle now settling down a bit, down 1%, ICICI Bank 2.5%, Kotak Mahindra Bank down 1%. So some banking names are under pressure this morning. But on the flip side, I can see on the gainers list, we are seeing a lot of these tech names extending gains. Infosys, TCS, HCL Tech, all of these stocks are gaining somewhere around 2 to 3% a piece in the pre-open. Last night, the ADRs of Infosys and Wipro did well, despite that cut that we saw in US tech names. Let's see, it'll be interesting to see how we open and which are the sectors that take the lead, because in the pre-open it seems banks would take a hit and IT would provide some support. So that's how things are looking at the current juncture, at least in the pre-open. Coming back to you, Raja, any trades for today? Let's first get that out of the way and then we'll look at more queries.
Sure. So I feel that the defense sectors are once again showing some interest, and I would say go with the long in BEL at around 450 with a stop at 445 for a target towards 458 for a 1 to 2 day play.
Okay, some of these defense names. But, Mayuresh, I also want to get in your thoughts on defense before I come to your compounding idea for the day. Defense stocks are likely to remain in focus, right? Because India is expected to formalize somewhere around 8.5 billion worth of defense agreements with Israel. And yesterday we saw the likes of data pattern jump quite a bit, 6%. And especially since what's happening on the geopolitics fronts, defense stocks have been doing well any which ways. But would you tilt more towards the PSU names, or would you look at the smaller private names?
I think a little bit selective, but I think the structural story remains. So because order books are probably showing revenue visibility or indicating revenue visibility over the next 5 to 6 years, to say the least. Margins are pretty reasonable. And the structural outlays that have probably been embarked upon, the budget has a decent chunk towards defense. And as you rightly pointed out, looking at how geopolitics is probably shaping up and looking at how we need to strengthen our arsenal and a lot of elements happening within India itself under the Atmanirbhar Bharat scheme. I think a large part of those increasing or impending orders also start coming through. So I think anybody holding defense companies should hold defense companies. Within the private names, I think obviously companies like BEL have done exceptionally well.
Okay. So that's about defense. But Mayuresh, it's time now to get in your compounding idea for the day from a medium term to longer term perspective. Any multi-baggers that you're spotting and that one can look at now?
I'm not sure of multi-baggers, Nandita, but our take is CCL products within the discretionary consumer space probably is well placed. They're expanding their capacities both in India and Vietnam, specifically in terms of the freeze-dried, freeze capacity packs. And the expectations in terms of input costs, coffee green prices probably have been on the lower side. Expectations are that realizations should be relatively better. Their B2C brand, Continental, is doing pretty well. And therefore, I think the servicing element, both in terms of the European and the American markets, should ensure steady state volume growth with margins in higher double digits, 18 to 20%, which probably means that free cash flow should also be on the higher side. So I think this is something that we believe can do well over the medium term.
Okay, CCL products. So that's the compounding idea for the day. But there's another issue that I wanted your thoughts on before I take up more queries. Mayuresh, SEBI's latest amendments, they've come with those AMC amendments, right? That will force mutual fund houses to rationalize their schemes, merge overlapping funds, and limit sectoral launches as well. But how are you viewing this? Do you see this as a positive cleanup that improves investor outcomes? Or will it slow AUM growth and product innovation in the industry? I wanted your overall thought on that.
I think step in the right direction. And again, I think what SEBI was probably trying to indicate was that there are too many schemes launched under different names and avatars, but I think the logic probably remains the same. So I think if you probably want to have a distinct product, it really has to be distinct, which probably gives the investor clear clarity in terms of what they're probably looking at. Secondly, I think even in terms of their long-term schemes, whether it comes to retirement planning, etc. I think that's very well laid out by SEBI. So I don't think it's a very disruptive process. I think the existing larger leadership AMC stocks might continue to be.
Okay. So within the capital marketplace, of course, brokerage stocks haven't done well. Of course, there's a good reason for that as well. So would you stick to AMCs and exchanges then, Mayuresh, when it comes to capital marketplace?
Largely AMCs and wealth managers, Nandita. I think two very quick reasons. One, I think in terms of the expectations of discretionary wealthy households actually doubling over the next 4 to 5 years seems to be a base case scenario. And second, you will need professional managers to probably manage their wealth across different asset classes, which these professions probably do. So I think asset management companies and wealth managers probably in a sweet spot.
Okay, asset management companies and wealth managers in a sweet spot. All right, let's take up a couple of more queries then. James has written in and he has a query on KNR Constructions. He wants your long-term view, Raja, on the charts. He's holding 300 shares at the rate of 241 rupees per share. He wants to know if it's a good time to accumulate more. Any thoughts? It's quoting at 135 or so. Or should he average?
Yeah, the entire real estate space has not been performing well, and we expected that post the RBI policy last year, the real estate sector would actually pick up, but that has not happened, and successive RBI policies have not been able to generate that kind of momentum in the real estate space. And now we are only waiting by the sidelines, waiting for the real estate sector to pick up. So I would say that. Right now, the way the things are poised, it should not be an averaging scenario. Actually, one should be looking to at least partially exit because the stocks look set for more downside, and the point of recovery is not yet seen. So I would say that it's not a good time to average.
Okay, not a very good time to average KNR Constructions. Hope that answers your query. I spotted a query on Motherson coming in from Harsh. He wants to know your thoughts, and the stock has done extremely well in tandem with other auto ancillary names. I think it is around that 52-week highs already, and it's gained in excess of 30% or so in the last 1 month. A good time to get in, or do you think the risk reward is not looking all that attractive?
Yeah, the stock is definitely showing a lot of promise, especially after the US and in India and England trade deal. And the auto sectors and especially the auto components have been performing quite well. And Motherson's is one of the true representative of that. But then getting in at this juncture would actually be a little, there'll be too much risk at work. So better to go on a dip levels closer towards the 120 region where it would be a suitable time to get into. So look for 120 levels to get into. The stock is definitely poised for more upside. So a dip would be a good opportunity to get into Motherson soon.
Okay, buy on dip. That's the strategy for a Motherson, Samvardhana Motherson. Hope that answers your query. Couple of queries on IRFC as well. The stock has been in news because of its OFS and how the government didn't really, go in for the green shoe option because the response wasn't all that enthusiastic. But we have a query on this particular stock, wherein I'm not getting the person's name. He's bought IRFC at 25 rupees. What can I do now? Hold for the long term or sell and book profit? Of course, 25 rupees and the stock is quoting at 100. Is it time to take some profits?
Yeah, definitely the writing is on the wall, and the railway stocks have not been really performing. It's more than a year now, and I would say that if he has made such a fantastic gain, then that should be the best course of action.
Of course, yeah, and congratulations on that profit. Despite the fact that railway stocks are not doing well, you are sitting on a hefty profit, and many congratulations to you on that. One query that has come in just now from RP wants to know your thoughts on M&M. Of course, the stock has been consolidating, but is it a good time then to look at it?
Yeah, M&M actually, after its good performance in December, the stock has not really been able to maintain that momentum. And I would say that stock is currently going through a consolidation. So yes, if you're in some profits, book some profits now, but no need to average or do anything, because overall the auto space is in a good spot, and they should continue to do well. But then the way M&M has moved over the last 1.5 years has been quite prolific. So, entering at this level would not be appropriate. But then, yes, one can definitely consider booking profits.
Okay, consider booking profits, but entering at these levels is not advisable. But let's focus in on some other stocks then from the banking space. I don't know why. I mean, let me just check what the rates are showing up now. But private banks have seen some bit of pressure, right? The likes of ICICI Bank and some of the other names like Axis have also seen some pressure. How would you approach them now?
Yeah, in the banking, if you see overall, the best performing index right now is Bank Nifty. Now, when you go deeper into Bank Nifty, you got the PSU, which is been performing consistently. There are more names up for grabs, but then in the private space, I would say the mid-tier private banking space, like say a Bandhan Bank or a Fed Bank, they seem to be performing better. So one should focus on those names rather than going beyond the axis. So the standard way of doing things has gone a major reshift. So it has reformed completely. So don't go behind the prominent names, go behind the names that are actually coming up. So these could be the next ones which are getting into the big league. So that's the focus which we should have for, I think, for the entire year, I feel.
Okay, that's the view. But 3 minutes to go for the markets to open. A couple of more stocks that I news. I want to get your thoughts on that. MSTC, that's emerged as the L1 bidder for Coal India tender, and the contract tenure is somewhere around 3 years. I think the stock has been extremely sideways. MSTC. What are the chart structures signaling now for this particular stock? Is this worth a look?
The news flows are encouraging, but I would say that it would again take some time, and definitely the sideways consolidation which it has been experiencing over the last several months. I think that can persist till we see some more momentum here. But yes, it's an accumulation kind of scenario. So if you have capital to invest, then one could consider. Otherwise, it's best avoided.
Okay, that's the view. It's best avoided. Also, another one that's GMDC. It has signed an MOU with NTPC to explore advanced gasification of coal and lignite resources. The stock has, rallied well, for 40% in the last 6 months. If you talk about this particular counter at 580 or so, what is the kind of upside you see from here? And is a sell on upside the kind of strategy one should adopt here?
GMDC in the latest metal rally, where certain names have really performed well. One of the names is GMDC. So yes, this stock continues to show some promise, and I would say that at current levels, it augurs well. And overall, with the metal sector itself looking promising, and also the global cues are also supporting. So I would say that the stock has got more upside here. You can say at least you can expect a 15 to 20% within the next 6 months.
Okay, expect 15 to 20% within the next 6 months. Okay, just a couple of seconds, a few seconds for the markets to open. Let's see how things really pan out, because of course it is expected to be a subdued start, 30-40 points kind of a cut on the Nifty. Yes, the first ticks are a 50-point cut, are suggesting a 50 to 60 point cut. 25 450, we've given up that level, and for the Sensex as well, we are down over 200 points. The mid-cap index moving largely in tandem with the benchmarks as of now, but let's see how things really pan out. The advanced decline ratio, it's almost even Stevens, but skewed in favor of laggards. We'll see how things pan out, because early days to really comment on a trend, but as of now, hinting at a negative breadth as well. Just want to see in terms of sectors, the Nifty Bank Index is downbeat as well, subdued open, but just want to see what the IT pack is really doing. Given the fact that we had good moves coming in from some of these ADRs overnight. So the Nifty IT index should really come up on your screen. For the Nifty Bank index, of course, it's a half a percentage point cut. So pre-open rates were already showing downbeat moves, and that's exactly what has happened. IT is up 2%, and that's the only sector in the green. So value buying continues for a third straight day in IT names, and looking at the movers on the IT pack, it's Emphasis that's up 3%. Infosys is up almost 3%. Top Nifty gainer, yes. Tech Mahindra up 2%. HCL Tech up 1.5%. So all 5 gainers on the Nifty right now are from the technology pack. Infosys, Tech Mahindra, HCL Tech, TCS, Wipro. So value buying continues at lower levels. In terms of the top laggards, metals, top laggards at the current juncture. Metals have seen a good run, so perhaps a bout of profit taking there. Vedanta is the top laggard on the metal index. It's down almost 1%. Lloyd's Metals, that saw very, very good traction on the back of a brokerage call yesterday, is down almost 1%. Nalco, JSL, SAIL, Hindalco, all of them are under pressure. Even PSU banks, for that matter, are witnessing some bit of profit taking here. Indian Bank is down 1%. PNB, Central Bank, Canara Bank, all of these stocks are down. And SBI also down, trading with cuts of somewhere around 0.3% or thereabouts. Pharma, that has seen good traction in recent times, that's also down 0.5%. Energy, banks, autos, FMCG, all of these stocks are trading in the red. Looking at the... Okay, one last question to Raja. Raja, anything on the pharma pack? Some of these names have seen good traction in recent times. Yesterday as well, you had Dr. Reddy's, Sun Pharma, all of them buzzing in trade. Anything on the pharma side that you like?
Yeah, from the pharma pack, I would say that Fortis is a stock that is coming out of its shadows. And at the current juncture, it seems to be a good setup for a multi-day play. So at current levels of around 970, I would say that with a stop at 950, you can target the region of around 1040 within the next 1 week.
Okay, that's the view on pharma. With that, Raja, I would like to thank you for taking out time. Of course, it is turning out to be a subdued Friday, but talking to you always reminds me of the weekend, because we connect every Friday, and that's something that I really look forward to. But as of now, as we speak, the Nifty is down 100 points, so the selling is only accelerating. But let's hope we stabilize as we progress through the session. But thanks a lot for taking out time and joining in, Raja. Always a pleasure.
Same here.
Thank you. Well, as I mentioned, the cuts have deepened a bit. The Nifty is now down over 100 points, and mid-cap index as well, it's down almost 0.5%, and the breadth of the market has turned sharply in favor of the laggards. So it's 1:2, that's the NSE advanced decline ratio. So not looking all that cheerful this Friday. Let me introduce Nikhil first. Nikhil Khandelwal, Chairman and MD, Systematics Group. Nikhil, lovely chatting with you this morning. If you could, hear my previous question, do you think we've discounted all the global risks given the kind of sell-off we saw earlier in the week, or do you think there's more to come?
Hi, good morning. Well, I think in terms of the market, we have had almost since the good news of the US tariff getting sorted and the EU and the US trade agreements getting signed. There was a significant buoyancy in the market participants among the market participants. I think the entire technology related disruption, as well as in general the whole war kind of environment which is kind of picking up in the Middle East, that has kept everybody's the risk capital has been off the market. We believe that in general, we are in a much better position as far as our business dynamics within the country, as well as our export potential of our businesses from India is concerned, and market is overreacting to a lot of things, which is happening across the world. And this is potentially we are entering towards the fag end of the kind of a poor market, and we expect that March may be showing us a new low, but I think from there on, market should be looking at much better momentum from there on.
Okay, so is some more selling to come through in March, you're saying? Some more, and then perhaps after that, we'll see some bit of a pickup in the market. But you've said that the markets have been overreacting to a lot of news flow. Would you say that the markets have been reacting to the news flow around AI as well? Some are in wait and watch mode when it comes to IT, because they want to see how things really pan out. Even Nvidia CEO has said that the market is really not reading it correctly. What are your thoughts when it comes to this entire AI disruption and post the correction that we have seen in IT on a YTD basis, on a month-to-date basis, 20-25% kind of correction? Do you think valuations are looking much more palatable now, and it's a good time to look at these stocks on the basis of that?
Yeah. No, so IT, I think as a sector has been a laggard for a very long time. I'll say if you look at even from a 5-year perspective, the top IT stocks, the Infosys, the HCL Tech, the TCS haven't really generated significant returns for investor. If I'm not wrong, they have generated less than 8-9% on a 5-year absolute basis, while on a year-on-year basis, the stocks are down 15-20%. Also, in general, IT used to at one point of time have close to about 14% weightage of the index, and now which is down to about 11.5%. In our view, IT would continue to be would continue to be I'll say underperformer as far as the markets is concerned. The weightage of IT in the overall indices is bound to go lower. I'll say the IT services weightage, while if in general, if there are other SaaS or fintech companies which slowly and steadily make way into the indices, that'll be a different case. But the IT services pack weightage is bound to go lower, and as a result of that, it will be a kind of an underperformer to the markets. Having said that, in businesses of that scale and magnitude, they are trading at their lifetime low in terms of multiples. So there is trading possibilities. We believe that all the top 3-4 names provide significant trading uptick from these levels. The market does overreact on the AI related disruption on the sector. There is definitely disruption. There is definitely going to be impact on their business, but there are also going to be a lot of green shoots within their businesses. Nobody knows how it's going to play out. From a valuation perspective, we believe that these companies available at less than 15 time trailing earnings provide significant valuation upside, and which is more from a short term perspective. So from a 5 to 10% kind of a trading bet, one can look at IT, but from a long term, I think it will be an underperformer on the index.
Okay, long-term underperformer, but from a short-term perspective, it could be looked at as a trading bet for a 5 to 10% kind of an upside. Before I talk about certain pockets, just want to understand, for us, India, of course, today is set to release a new GDP series with FY23 as the base year. and nominal GDP for the current fiscal is seen at around 8.4%. Could this reset earnings expectations going forward? What is your view? Because last time around when we had the GDP figure coming through, nominal GDP of 8.2% was extremely disappointing. How would you look at a figure of 8.4, 8.5% in terms of nominal GDP? Do you expect it to continue to pressure India Inc.?
Yeah, according to our assessment, we have just come out with a detailed note yesterday. According to our estimate, the revised methodology will lead to more realistic numbers as far as the GDP and other data is concerned. We believe that the surprises will be on the downside, so the GDP numbers, etc., will be lower than what we have been seeing. It will also be more reflective of what actually is happening on ground. There was a lot of discrepancy in terms of the data which we were seeing on the rural side, on the inflation side, and what was coming out of the GDP. A lot of that correction is being done in the new methodology, and the numbers will be on the lower side. It will be lower than what we have been seeing in terms of 8%, etc. Having said that, whether this will impact the markets and the market participants, I think markets and market participants have largely discounted the entire slowdown in the economy. If you see the overall revenue growth within the Nifty pack over the last 6 years, it's been just about 5 to 6%. It is clearly reflective of how the economic growth has been. So I think those kind of numbers will get recalibrated when we see the GDP number today. So the numbers will be on the downside. People will get a reality check. But having said that, I think the data about how the economy is doing, and the numbers have largely been discounted on the index. So shouldn't have a major reaction on the index. But we are in for a data on the lower side.
Data on the lower side. But in that sense, then what are the expectations in terms of earnings for the next fiscal?
Well,
a realistic
I think
one,
next,
for that matter.
No, of course. I think realistically we are looking at the next year being much better for the India Inc. Last year has been probably the most disruptive, especially led by the impact on due to the US tariffs and a lot of trade related disruptions globally. So a lot of the companies actually saw significant unwinding of their inventory, which they were sitting on. It also led to a lot of disruption on the overall banking space. So we believe that this FY27, which is the next financial year, will throw out a double-digit earnings growth for the BSE 500. And for the Nifty, we believe that the earnings growth will be close to about 14-15%. We believe that major export-driven businesses from the automotive side, from industrial side, will see a significant uptick in their revenue and profit growth in the next financial year. We believe that the banking sector will also show close to 12 to 13% advances growth next year, and we will also see a fair bit of consumer-driven earnings growth as well, which hasn't come in a big way in this financial year due to some inflationary pressures. So a combination of that, the next year earnings growth for us for Nifty is about 14 to 15%, and for the larger BSE 500 is about 13 to 14%.
Okay, at least somewhere around the mid double-digit mark. But when you said that consumption, perhaps earnings could see a comeback, would you be talking about the discretionary end, or would you be more tilted towards staples?
No, so actually, the growth is across the spectrum. According to us, there is the premiumization theme within the discretionary consumption. pack will continue to play well. There is significant capital sitting in the rural and the tier two tier two households, and that will continue to be a big growth driver for consumer pack in general. There is the staples as a pack. We believe that under penetrated categories, or categories which are seeing more move from unorganized to organized, like for example dairy as a pack, for example the packaged spices as a category. I think these pockets, although they are small, will be more disruptive, will be seeing significant growth, even for a player like ITC and Unilever, etc. These packs will show faster growth. But the overall weightage for us will be on the discretionary space, where we believe that as the discretionary pool of companies like the Titans, the retail brands, etc., they continue to expand their footprint beyond the metros into tier 1 and tier 2 cities. There, they will show significant momentum in their profits and revenue growth in the next few years.
All right. Okay. Discretionary spending, of course, is picking up, and that's where you guys are also bullish. But last question, really, if you had to pick something within the BFSI space, PSU banks, like private lenders, life insurance, small finance banks, where is the risk reward looking more compelling over the next 12 to 18 months? And which end of the spectrum would you be looking at within the space?
Right. I think so. As a BFSI, as a pack, we are seeing that among the larger banks, the balance sheet strength is actually at its best. The ROAs for PSU banks, the large PSU banks, is in the range of 1.1 to 1.5%, while they trade at less than 1 time book value in most of the cases. In private banks, also ICICI and Axis, which are our preferred picks, are trading at close to 2 time book, while their ROAs also are in the 2.5% range. So definitely among the larger private as well as public sector banks, we have preferred picks, and we believe that they will be good. They'll be outperformers as far as market and in general the financial pack is concerned. But we believe that the maximum alpha will be generated in the small finance bank pack. Besides the general credit growth which we are seeing in the entire financial sector, the small finance banks in general are actually seeing a significant uptick in their margins. They are actually expanding on their other income growth driven by credit card and home finance, etc. They are also significantly moved from unsecured to secured lending, which is going to which will drive significant valuation uptake for them, significant ROA improvement for them. And these banks are also becoming geographically well diversified from being a regional play. So a combination of those factors and them trading at less than 1.5 time book provide significant conviction that these banks will outperform the entire financial stack. So from large bank like AU Finance to Ujjivan, Equitas, or even a smaller name like Capital Small Finance Bank, we are bullish on the entire pack.
Okay, this was supposed to be my last question, but since you mentioned AU Small, the recent, the developments with IDFC First, small, even for AU Small, do you think that won't dent sentiment when it comes to smaller banks?
No, actually, these banks are, I'll say, first of all, this IDFC Bank episode was kind of an issue created by lack of oversight, and of course more about a few individuals who created the issue for the bank, and what led to that entire kind of a fraud which is being investigated. But in general, I think the banking sector, most of these, at least the small finance banks, are driven by very strong promoters. B, I'm sorry. So, secondly, I think
No worries.
the entire technology stack within these banks provide for these kind of issues to be well taken care of. So, we feel that some of these issues continue to happen in the lending space, not just in financial in banks, but also in NBFCs. They have put enough checks and balances. I think IDFC issue is an unfortunate event, but we don't believe that will lead to a significant issue or overhang
Okay.
on the banking sector in general.
Sure, isolated incident and not really a systemic risk, as has also been pointed out by the regulator itself. But with that, Nikhil, would like to thank you. Appreciate your joining in. Always a pleasure. Have a great day ahead.
Thank you. You too. Bye.
Well, thank you. Well, on that note, let's move on to the next guest, Rakesh Vyas, CIO and Portfolio Manager of Quest Investment. As promised earlier, he's joining us now. Rakesh, great to have you on the show. First of all, I want to get in your overall thoughts on the markets. Things have been looking pretty okay recently, although we've been trading in a range. But the good point is that the FIIs have made a comeback, right? At least in the month of February. Do you think this is a trend reversal when it comes to FII flows, or do you think it's really short-lived and they need more conviction, at least when it comes to earnings? What are your thoughts, and where do you expect the markets to head? Do you think the worst on the AI front and on the other bad news is already in the price when it comes to the market?
Yeah, hi, good morning. Thanks for inviting me and glad to be here. You are right. I mean, if you look at from the earnings perspective, we are seeing gradual earnings improvement over last few quarters, and the expectation is that in next FY27 we'll probably see between 12 to 14% earning growth. And I think as earnings are gaining traction, there was an expectation that at some point of time, sustainable earning growth will drive FIs back into Indian market. Unfortunately, the whole AI trade and the IT services meltdown that we have seen has impacted the overall market sentiment to a certain extent. I believe that, of course, the AI opportunity and fear both is real. I am still not very clear as to whether what kind of opportunity does it provide for Indian IT services companies going forward, and that's the reason why we are seeing this overall derating in the space. February month FI inflow is really positive, probably a good start, but I would still believe that they would probably want to wait out for reasonable visibility on this earning growth trajectory panning out over next 2 to 3 quarters, and that's the time when we'll probably see a reasonably strong comeback from the FIs, in my view. Of course, sporadically, in cases where either you have blocks or QIPs, etc., you will probably see days when FIs may either look at large inflow or outflow depending on how blocks are placed. But overall, in general, I'm saying as you move towards the second half of this year is when I expect FIs to see India as a meaningful opportunity for incremental investment.
Okay, for second half, of course, from second half rather, perhaps we could see incremental FII flows coming through. But you said that you are really not very sure about how these things, AI, of course, AI disruption will pan out. In the sense, you're not really convinced whether it would be an opportunity for IT. Do you think much of, although the kind of correction that we've seen on the stock prices, do you think much of the worst has already been priced in, or do you think there's more to come?
I think I would agree with you. I mean, large part of the hit that was expected is largely priced in. But you also have to see the context that, especially for the larger IT services companies, last 2 3 years has been reasonably weak in terms of growth. And therefore, given that these franchises have very strong cash flow generation, strong dividend and cash flow yields, was what was supporting them the kind of P's that they commanded, which was closer to or higher than the overall Nifty or market P in general. But the fear that this AI disruption is actually going to lead to a lot of productivity improvement may also lead to a lot of incremental work coming by for IT services companies, but offset by broad-based productivity improvement could actually lead to a scenario where growth could still remain very very tepid or may actually be missing. And in that context, the current price to earning multiples broadly captures that kind of risk. Therefore, I'm not very sure as
Okay.
to next medium term what kind of growth rates one can expect from IT services companies with the push and pulls that I just talked about, and the kind of terminal growth rates that really expect for these companies in general is something where I definitely don't have very clear insight, and that's something that I'm trying to grapple with. But as I said, I mean, valuations have come to a point where meaningful decline from here is very unlikely. But is there a possibility of a strong rebound or a re-rating? Is also not very clear.
Okay, okay, got your point. Okay, let's veer away from IT then. Just going through your holdings, both of your multi-cap and flagship funds have a heavy tilt towards financials and consumption. So within financials, what do you like? Because we had Nikhil Khandelwal of Systematics joining in earlier. He said that he was bullish on some leaders within the PSU banking names and some in private banking names, but he felt that the real alpha will be generated by the smaller banks, small finance banks. Where are you at within the BFSI universe? Where do you think the next wave of alpha can be generated?
So if you look at our portfolio, right, I mean, financials is a very large contributor to our overall portfolio, and so is with the market. But within that space, we are probably more tilted towards some of the larger private banks where we still see meaningful opportunities for some valuation catch-up banks like Axis Bank, to certain extent HDFC Bank as well. But we have been early in the small finance bank journey. We had exposure to AU Small Finance Bank earlier. But in recent times, we have also strategically shifted away from what I think you have just indicated, from the larger banks to some of the smaller banks, so to say. So our exposure to small regional bank like City Union Bank has been something that we have added, moving away from the larger banks.
Okay.
And also we have started to look at some of the NBFC space, because that's one pocket where we believe that both the credit growth expectation is going to be reasonably strong, as well as the cost of fund benefits will probably start to flow through, improving their margins as you move into next 2 to 3 quarters. But I also want to highlight that as credit growth in the system is increasing, the fight for deposit is also very real. And in that scenario, it is also very that we probably have reached the bottom of the deposit rates largely, and therefore the only repricing of the older deposits to this new rate delta that remains. But on an incremental basis, I don't think we'll probably see any meaningful decline on deposit side, and also not likely to see any meaningful change on the yields as well. And that's where I think broadly NIMs will settle at on incremental basis. But the overall growth into the credit cycle is going to be very, very strong. So we have already seen over last months, the overall advances growth for the banking system in general has moved from lows of maybe 8-9% to 12 to 14% now. And that's the reasonable expectation that we have for next 12 months.
Okay, credit growth is expected to be strong. But since you mentioned NBFCs, any particular segment within the NBFC pack that excites you more? Gold financiers, housing finance, consumer finance. Just want to break it down further for our viewers.
So two plays that we are actually thinking of or have part of our portfolio. One is actually more diversified NBFC financiers. So if you look at the larger NBFCs in general,
Okay.
going beyond likes of Chola and Bajaj. You have a new entrant like Tata Capital, where we believe that there is a reasonable strong growth expected both on the AUM side, but also continued improvement in the operating efficiency and reduction in the credit cost is something that's going to drive earning growth over next 2 to 3 years. So that is one bet that we have. In the affordable housing finance space, we have some exposure as well. But that's a space where we still have to see growth gaining traction from here on. Because as you see in last almost a year or so, the growth have been slightly moderating in general because of the competitive intensity that we saw. So I think that is one space where we'll probably see stronger growth as we move forward.
Okay, okay, got your point. That was about the BFSI universe, but since I also mentioned consumer or consumption space,
Yeah.
consumer discretionary services together form a very large portion, right? So, domestic focused portfolios, is that your tilt? And, within consumption as well, discretionary, would you like the more premium end?
Yeah, so on the consumer discretionary side, you're right. I mean, we have a reasonably large exposure as well, and that's something that we have been carrying for last almost 2 years or so, with the belief that the government pivot also from infra to consumption was something that was driving that traction. Our exposures are largely towards, as you indicated, the domestic names largely. So we have some of the platform companies on food delivery and quick commerce space as part of our exposure. Also, we are reasonably positive on the retailers, especially the apparel retailers with the likes of Vishal and Trent, etc. And also have been positive on the auto and auto ancillary space in general, because that's where the large benefit of overall GST rate reduction was expected to drive strong growth, and that's what something that we have seen as well on the auto side over last 3 to 4 months. And we believe that it's probably a start for at least for the medium term for next 3 to 4 quarters, strong growth coming through as well. So these are the names that we have been positive more towards on. We have also started to just highlight, look at export as a theme or as an opportunity, given the fact that there are a lot of these FTAs or deals that we have signed across various geographies that provides medium to long term growth opportunities for Indian manufacturers or Indian exporters. So that is a theme that we are just starting to explore too. We have taken exposure to some of the EMS companies recently, which have large sales directed towards US, where the high tariff regime was something that was a concern for margin and growth, but they have countered that well, at least in last 12 months, and with this new rates that are being announced between US, India, or maybe globally now. So these will provide reasonable, meaningful opportunities for some of these EMS companies as well.
Okay, interesting. EMS stocks have really come under a lot of pressure in recent times, any which ways, but still you guys are constructive on it and have taken positions. That's really interesting. But last question, really, how would you look at pharma? Because your allocation to pharma is a bit modest compared to these other, financials, consumption, etc., that we spoke about. So, would pharma be more of a tactical allocation rather than a core bet for you guys?
So if you look at domestic pharma in general, so there has been reasonable growth across the board, but valuations have been always very, very punchy, and therefore it becomes difficult to justify buying at those valuation. That's why we have remained slightly underweight on that space. Space that we have been far more reasonably constructive on, I would say, is CDM. Of course, that is one space where you have a lot of volatility across, quarters or across years, depending on, how your end consumer or end product actually flows through, and there are risk of geopolitics, etc. And we have also seen that some of these stocks have corrected as well from their peaks over last 12 to 18 months, and therefore they right? They provide a reasonable opportunity to relook at that space now incrementally as we go forward. So I think we are slightly more tilted towards that space where we believe that at least for India, the CDMO or CRDMO space in general, both in the pharma as well as in chemical or specialty chemical, is a reasonably long story that can play out over time. So we just have to find, place where we can have meaningful confidence on with the kind of reasonable valuations that we see now. So we had some exposure, as you rightly indicated, on pharma, but we haven't been overly bullish there as well. Few sectors that we have been reasonably underweight for last maybe couple of years have been consumer staples, IT services, and to certain extent pharma and chemicals. Largely pharma, I would say.
Okay. Point taken. I take your point. But I think with that we are coming to the end of this segment. Rakesh, would like to thank you for taking out time. It was a pleasure chatting with you and getting in your insights. Wish you a very happy weekend and the rest of the day as well. We look forward to more interactions on Moneycontrol with you.
Thank you. Thanks.
Thanks a lot. Well, that was Rakesh Vyas with his thoughts on the market, the sectors that are looking good at the current juncture, and of course, some very, very good ideas when it comes to wealth creation as well. But let's take a look at the market because the cuts have only deepened. The Nifty is now down 150 points. We've broken below that 25,350 mark as well, and that was really being looked upon as a crucial support zone, the 25,350 to 25,400 mark. If we close below this level, there could be some hiccups for next week as well. Mid-cap index, the cuts have deepened there even further. The mid-cap index is underperforming the benchmarks. It's down almost 0.8%. The bank Nifty, which has been resilient thus far, it has, it's now witnessing cuts of over 0.5%. Almost a 400-point cut coming in on the Nifty bank index. It's below that 61,000 mark as well. Breadth of the market is poor, 1:2. That's the NSE advanced decline ratio. If you look at the sectors, IT surprisingly is doing well, extending its gains for a third straight session. That index is up 0.8%. But aside of that, all the other sectoral indices are trading in the red. FMCG is now taking the lead when it comes to the laggards. Real estate is the second one. Autos are also witnessing some bit of selling pressure. That's down 1%, the Nifty Auto Index. PSU banks under a fair bit of profit taking. Pharma pack as well has given up gains. And metals, that happens to be the metal index that happens to be the top sectoral mover for the week, is trading with cuts of 0.5%. For the week, I just want to take you through what the sectoral picture is looking like. The metal index is up 3.5% for the week. Pharma is the other one that has been doing well in recent times. That's up 3% for the week. Autos did well today. Vahan registration data for February shows very good traction. So autos up 2% this week. PSU banks, they have given continued support to the market in recent times. That's up 1.5%. For the week. So yes, for the week, some of the sectors are looking pretty good. But for the day, barring IT, all the sectors are trading in the red. Just want to quickly take stock of some of the mid-cap movers because we haven't really looked at them throughout the course of the show. Vishal Megamart, because of that block deal, 14% equity exchange hands. So that stock is down 7% almost. Bandhan Bank is under pressure. Some of the other BFSI names like L&T Finance under pressure, down 4%. You have some of these railway names like Jupiter Wagons under pressure. Largely some of these NBFC names like Aditya Birla Capital, Credit Access Grameen, even some of the brokerage names like Angel One are down and out, 4% down. CAMS is down 3%. A lot of these movers, and they're down anywhere between 4 to 10% in trade. But on the upside, you have Reddington, that stock is up 10%. Tejas Networks up 7%. Some other movers like Praj Industries, Sun Pharma, Sun TV, I beg your pardon, RR Kabul. So yes, lots of movers as well. But on the index, you have some of these IT names that are dominating the slim list of gainers today. Infosys, HCL, Tech Mahindra, TCS, all four clocking in gains of anywhere between 1 to 1.5%. Eternal, after multiple sessions of cuts, this stock is emerging as the top Nifty gainer today, up 1.5%. Well, that's the market, and of course that wraps up today's opening bell as well. But before I go, just want to take this opportunity to tell our viewers that this happens to be my last opening bell show on Moneycontrol. Over the last 3.5 years, it has been a remarkable journey, and I have loved bringing news, getting all your stock-related queries answered, interacting with you guys. I've had very strong response from you guys. You've appreciated my work. I've had some big bats as well along the way, but that's all only a part and parcel of this game. And I've really thoroughly enjoyed myself here on this platform. So would like to thank you for being a part of this very, very remarkable journey. And I look forward to meeting you guys again, maybe sometime, someplace soon. Let's see. But thank you, a heartfelt thank to all the viewers for all your continued support. Thanks a lot for watching. Stay tuned to Moneycontrol for all your other news and updates. This is me signing off from Opening Bell.